I'm Daniel.
And I'm Mira.
U.S. equities they just survived a brutal mid-session slump today to close slightly mixed in what was a wildly choppy session.
Oh, absolutely.
You essentially had the market fighting against a massive surge in oil and this incredibly stubborn inflation print that's, it's forcing investors to basically reevaluate the rest of 2026.
Yeah, the playbook is out the window at this point.
Totally. So just a quick rundown of the May 12, 2026 closes. S&P 500 futures slid hard early on, but they managed to recover and close at 7,421.75.
Right.
Meanwhile, the 10-year Treasury yield marched higher, hitting 4.463%. But the real headline today, the one you simply couldn't ignore, was oil.
Yeah, WTI crude just went parabolic.
Exactly. It surged violently past that psychological $100 mark, peaking at $102.72 before it settled right at $102 a barrel.
Which is just a massive level for the broader economy. And for our deep dive today, we're going to cover the rather hawkish overnight signals we got from Japan. We'll also unpack that hotter than expected U.S. CPI print that clearly spooked the Fed. And then we'll recap how corporate America and everyday households are actually absorbing these macro shocks.
Just some quick legal housekeeping before we jump in. This deep dive is purely for market context and discussion. It's really just to help you understand the baseline environment you're operating against.
Right. It is absolutely not personal investment advice or a recommendation.
Exactly. So what set the stage before the U.S. session?
Well, you really have to look at the macro floor that was established back on Monday, May 11th. I mean, the market opened today with an immense energy risk premium already heavily priced in.
Yeah, you couldn't miss that stark warning from Saudi Aramco's CEO, Amin Nasser, on Monday.
Exactly. He basically came out and said the world is facing its largest energy supply shock ever. He noted we've already lost roughly 1 billion barrels.
Wow.
And he added that if the Strait of Hormuz remains closed, we're going to lose 100 million barrels every single week.
Which is just an unfathomable amount of physical supply to pull off the market.
Right. And it acts as this massive backdrop of geopolitics as calculated brinkmanship. It essentially keeps a rock-solid floor under inflation no matter what domestic demand looks like.
Yeah, and that physical reality bled directly into the overnight policy action from Asia. I want to talk about the Bank of Japan's April Summary of Opinions, which dropped late Monday at 4:50 p.m. Eastern Time.
Oh, right. The tone of that was incredibly surprising.
It really was. It was surprisingly hawkish. One BOJ member flat out stated that their real policy interest rate is by far the lowest globally. And because of that, they must keep raising rates, quote, every few months.
And the reason why they are signaling that is pretty clear. I mean, Japanese officials are just terrified of sharp price surges driven by these supply-side constraints from the Middle East tensions.
Right, because they import everything.
Exactly. When your currency is weak and oil is priced in dollars, a weak currency acting as imported inflation becomes a genuine crisis.
Which perfectly explains those emergency U.S. Japan foreign exchange talks. Those happened overnight, May 11th, right around 5:22 p.m. Eastern Time.
Yeah, between U.S. Treasury Secretary Bessent and Japan's Finance Minister Katayama.
Right. And they focused heavily on curbing excess currency volatility, as well as managing critical mineral supply chains. The USD-JPY pair still edged slightly higher, actually pushing past 157.50.
But the verbal communication was very clear.
Oh, absolutely. Both sides made it explicitly clear that excess foreign exchange volatility is highly undesirable. But okay, let's unpack this for a second.
Sure.
Is Japan's hand just being forced here? Like, a weak currency as imported inflation is completely unbearable when oil is skyrocketing past $100. So does this mean the global yen carry trade is essentially destined for a rapid unwind? Because if so, that threatens global liquidity in a massive way.
It's a huge risk. Japan is trying to strike this incredibly delicate balance. On one hand, they desperately need to support their currency to survive the energy shock.
Right.
But on the other hand, they're well aware that if they move too fast and spark a mass unwind of the yen carry trade, they risk collapsing global risk assets entirely.
So they're walking a tightrope.
A very thin one, yes.
So basically, we entered Tuesday with a hawkish Japan, a completely terrified oil market, and a super tense currency backdrop.
That was set up, yeah.
We'll take a quick break, and when we come back, we'll dive into what happened when that fragile setup violently collided with today's U.S. inflation data.
Welcome back. So what moved markets during U.S. trading hours?
Well, the sledgehammer was definitely the highly anticipated April CPI report. That dropped today, May 12, at 8:30 a.m. Eastern Time.
And it was not pretty.
Not at all. Inflation came in hot. Core CPI rose 0.4% month over month, which puts it at 2.8% year over year. Headline CPI hit 3.8% year over year.
Wow.
But the truly alarming part, the metric everyone was sharing this morning, was supercore inflation. That jumped to 3.38% year over year.
Which is just brutal for the Fed, because this stubborn inflation severely diminishes any lingering hopes for near-term Federal Reserve rate cuts.
Oh, it kills them.
Yeah. Chicago Fed President Austan Goolsbee, speaking at 1:14 p.m. ET today, was incredibly blunt. He stated the report was, quote, worse than expected, and that inflation is going the wrong way.
Yeah, and he specifically pointed to that upward drift in services, which is what that supercore number captures. Central bank credibility as an inflation anchor is really being tested here.
Absolutely.
And to make matters worse, we have to connect this inflation dread right back to the energy markets. At 12:03 p.m. Eastern Time today, the U.S. Energy Information Administration dropped an absolute bombshell of a projection.
The EIA report, yeah. What's fascinating here is just how dire their warning actually is.
Right. They are basically assuming the Strait of Hormuz will remain closed through late May, with war-related shut-ins peaking at 10.8 million barrels per day.
And their warning goes further. They noted that if the closure extends through late June, crude oil prices would likely rise another $20 per barrel.
Which puts us well over $120.
Exactly. Furthermore, they explicitly stated that pre-conflict trade patterns won't fully normalize until late 2026 or even early 2027.
That is just a structural nightmare for global trade. And the geopolitical vice is only tightening. Today, President Trump stated that the blockade has actually been effective.
Oh, interesting.
Yeah, he predicted a, quote, gusher of oil coming to Texas to offset the losses, and then he threatened that Iran will either make a deal or be decimated.
While meanwhile, Iran is demanding 5 strict preconditions for talks, which includes demands for war damages compensation.
Right, so neither side is backing down.
No. And this perfectly illustrates how these energy shocks function as a lagged consumer tax. It's slowly squeezing corporate margins, draining consumer wallets, and giving the Fed absolutely zero room to maneuver.
Yeah, it's bleak.
But actually, I want to push back on this geopolitical narrative for a second.
Okay, go for it.
Rather than treating this conflict like some unpredictable natural disaster that we just have to endure, let's look at it through a game theoretic lens.
Okay, I like that.
Both the U.S. and Iran are heavily incentivized to maximize their leverage right now. Is it possible the market is actually underpricing the probability of a negotiated settlement? I mean, neither side truly benefits from a multi-year paradigm of oil sitting over $100 a barrel.
That's a really fair point. It's a high-stakes game of chicken, but a resolution would instantly collapse that risk premium. And honestly, that might explain the bizarre market reaction we saw today.
Oh, with the equities?
Yeah. Despite the hot CPI and despite Goolsbee's warnings and oil surging, some indices actually climbed. The Dow ended up nearly 350 points today.
Which makes no sense under traditional models.
It totally contradicts the narrative that high rates and high oil should automatically crush equities. It really makes you wonder if our macro narratives are blinding us to micro-level risks, or in this specific case, micro-level resilience.
That's a great way to put it. So just to summarize, hot inflation, oil surging past $100, and a Fed completely backed into a corner really defined the U.S. session today.
Yep. After the break, we'll look at how specific corporations and households are absorbing these massive shocks and what you need to watch tomorrow. Welcome back. So what is our corporate events recap and what do we need to watch next?
Well, let's start with the tech mega caps and the massive AI capex cycle. Because there was a huge restructuring finalized late Monday, May 11th, right around 9:11 p.m. Eastern Time.
Oh, the OpenAI and Microsoft deal.
Yes. They completely revamped their revenue agreement. The details are wild. Microsoft's revenue sharing payments are now strictly capped at $38 billion.
Which is still a massive number, but having a cap changes the math entirely.
Right, because this move is projected to save OpenAI an unbelievable $97 billion through the year 2030.
The scale is just staggering. I mean, Microsoft has already made over $30 billion in OpenAI-related revenue. It perfectly highlights this whole theme of AI capex as a cycle-agnostic arms race.
Oh, completely.
These companies are playing for stakes that are so astronomically high that normal macro gravity just doesn't seem to apply to them. Think about discount rates as gravity on valuations. Normally, a 4.5% 10-year yield would crush tech multiples.
Right, but not today.
Exactly. Microsoft's stock closed largely unchanged today, and Alphabet actually rose. They just brush off the macro.
Well, the virtual economy might be brushing it off, but the physical economy is definitely feeling the heat, especially when you look at trade and tariff pressures.
Oh, yeah, that appeals court ruling.
Right. Late Monday, around 4:21 p.m. ET, a U.S. appeals court temporarily paused a lower court ruling that had previously struck down President Trump's 10% global tariffs.
And Trump followed that up with a quote to USTR Greer saying that, quote, "we need more tariffs," and that he plans to restructure them in a, quote, more complex way to basically charge more.
Which is terrifying for importers. It keeps a major input cost strictly elevated across the board.
So between $100 oil and 10% global tariffs, the physical economy is just getting squeezed from every direction.
Which brings us to the U.S. consumer. How are they handling this? The New York Fed released their Q1 household debt report today at 11 a.m. Eastern Time.
And the resilience is actually pretty shocking, isn't it?
It really is. Despite all this chaos, total U.S. household debt remained relatively flat at $18.8 trillion. And surprisingly, credit card debt actually fell by $25 billion.
Wait, really? It fell?
Yeah, it fell. Auto loans did tick up slightly, but the overall picture is far from a collapse.
There was also a crucial detail in that report that I want to point out. The New York Fed explicitly stated that fears of student loan contagion are premature. They actually suggested that the peak of student loan defaults may have already happened. And I think this brings up a concept we've touched on before, fixed rate debt as a household shock absorber.
Oh, absolutely. The mortgages.
Right. Millions of households locked in historically low 30-year fixed mortgages a few years ago. That massive fixed-rate shield is exactly why consumers aren't breaking yet, even with higher prices at the pump and the grocery store. Their biggest monthly expense hasn't moved a cent.
It's the ultimate buffer against this macro volatility.
Well, folks, with the CPI running hotter than a Texas summer and oil prices casually strolling past $100 a barrel, it seems the only thing getting a rate cut today is our collective optimism.
Yeah, no kidding.
If the Strait of Hormuz stays closed much longer, we might have to start powering our $700 billion AI data centers with sheer anxiety. But hey, look on the bright side. At least the New York Fed says you aren't defaulting on your student loans yet. Grab a surprisingly expensive drink, mute your portfolio notifications, and remember, there is always tomorrow to panic about the looming tariffs.
That is very true. And speaking of tomorrow, let's lay out the calendar for the next 24 to 48 hours because there is a lot to watch.
What's on deck for Wednesday?
So Wednesday, May 13, watch for the U.S. April PPI report at 12:30 p.m. Eastern Time. That is going to be a critical read-through for rates after today's hot CPI print.
Oh, definitely. Wholesale inflation data is going to be heavily scrutinized.
Then at 2:30 p.m. ET, the EIA weekly crude oil stocks report drops.
And given that Hormuz closure, that report is going to be hypersensitive. Every single barrel in inventory matters right now.
Exactly. And then later Wednesday evening, look out for the Fed balance sheet update, as well as scheduled speeches by Fed officials Williams and Barr.
Okay. And Thursday?
Thursday, May 14, is all about the consumer. At 12:30 p.m. ET, we get U.S. April retail sales and initial jobless claims. That will give us a major check on whether that consumer demand we just talked about is actually holding up.
So what does this all mean? I want to leave you with a final thought to mull over. If AI infrastructure is demanding nearly $1 trillion in capital right now, and global oil supplies are being artificially squeezed past $100 a barrel by geopolitical choke points, are we moving away from an era of pure digital innovation and entering a reality where raw energy sovereignty actually dictates who wins the global tech dominance race? You can't run a massive data center if you can't secure the physical energy to power it.
Let us know your thoughts on that in the comments, and we'll see you for the next Deep Dive.